Hello traders, this is Rich Terry from Tradesight. Just wanted to check in and share with you something that I saw in the weekly AAII Investor Sentiment Survey results that was pretty interesting. What we have in this last reporting period is we found ourselves with a really high number of bulls. We're up over 50% bulls, which is very, very unusual and notable for a couple of different reasons. And at the same time we've recorded this very, very high number of bulls, the neutral column and the bearish column have both dropped down below 25%. The reason this is notable is that there aren't people still kind of waiting and hiding in either the neutral or the bearish camp, waiting to make a decision. Most of these folks really are going to stay there. There's always kind of a preponderance to a likelihood to be over 20% in both of these readings, and their typical readings are usually in the 30% area. But we're well below those normal readings, and we've got this huge number in the bullish column. This is actually the most bullish that this reading has been since February of 2011. The only comparable reading came in 2012, where we had a reading of 51.6% bulls, which is not even as high as this. But let's take a look at the numbers and then move on and talk about what they might imply. Alright, so here's looking at an Excel spreadsheet with the numbers on them. And what we want to see is this low number of neutrals, low number of bears, and a big preponderance of these bulls. What I've done is anything that's above 50% in the bull readings, I've marked off in red. Anything that's below 25% for the neutral column or the bearish column, I've also marked off as well. You can see that in all the readings that we have on view here, this is the only time that we've been below 25% for the bears and the neutrals, and been above 50% for the bulls. Now keep in mind, this is a contra indicator, and that when everybody gets on board the long side, that's when you have to be concerned about and ready for a reversal to the downside. And not only ready for a reversal to the downside, but one that's actually going to have some merit to it and have some teeth and bite on the way down. Now if we scroll back a little bit further in time here, I just want to point out the other recent readings. This reading back in February of 2012, we had 51.6% bulls, but we didn't really have this real low reading in the neutral column. So it did lead to decline, which we'll look at later, but it's not quite, doesn't quite have the same teeth as when you get the readings like this. This is back to 2011, where we had all three conditions satisfied. We were below 25% in the bears, below 25% in the neutral column, and above 50% in the bullish column. And that's the setup for some kind of a meaningful reversal to the downside in the market. Now keep in mind here that one thing I wanted to point out, and the reason I was showing this in the Excel sheet, is that this condition was kind of apparent for a number of weeks here as the top in the market at this time was formed. Remember, tops take more time to form than bottoms. It's a distribution and an exhaustion phase, and just because we get one reading of 50% bulls doesn't mean that the market's going to turn lower the next week. What we need to do is make sure we check back in on this again in the subsequent survey, and then also look to our market internals as well to see if we detect anything that implies that a reversal is close at hand. The things that we're going to be looking at going forward are going to be the market internals like the put call ratio, to see if we get a climatic reading, and the put call ratio is just one that's just way too bullish. We'll also be looking at the advanced declines overall, and we'll also be looking at the condition of the 10-day trend. That's the 10-day simple moving average of the trend. If these start to line up and start showing overbought indicators, then we're gonna zero in on finding an inflection point. But for now, let's just make sure that we understand that we do have a climactic amount of bulls. This can repeat itself for a week or many weeks. Depends on what the market wants to do. But when we do get a turn, we really have to be ready for something meaningful to happen. Okay, now here's a look at the S&P cash index in the weekly time frame. What I've done here is I've taken the chart and marked it up and shown where these initial bullish readings line up with the performance of the S&P. Here's the reading that we got in February of 2011. That's the last reading that's comparable to where we are now. It's actually a little bit higher. You can see that we did start a little bit of a corrective activity, and the market kind of started to lose its grip on this rally. We actually started tracing out this expanding pattern, even though it's not marked on here. We have higher highs, and at the same time we're setting up lower lows that ultimately resulted in this drop that was pretty nasty and really was very tradable on the short side if you were ready for it, even if you're not predisposed for it, but open-minded about it and ready to short because you had been aware of this climatic reading in the sentiment survey. The other indication, which was not quite as vigorous as the one we have now, was the reading that we got in February of 2012. This one was a little bit premature, and like we talked about before, it's not necessarily a timing tool, but it's kind of a warning to start looking more closely at your market internals and getting ready for some kind of a meaningful break to the downside, and we certainly got that. So we definitely had these climactic readings that preceded this big drop in the S&P, and we had climactic readings that preceded this smaller drop, but a tradable drop nonetheless. So here we are now. We're at range high on the chart. We're kind of dancing around that 1500 level in the S&P cash, and we have just recorded a climactic reading of bullish sentiment in the survey. So let's definitely make sure that we're keeping an eye on our market internals as we go through the next couple of weeks, and we'll check in again with you and post another video and update and see what the survey has to say for next week. So until then, this has been Rich Derrick from Tradesight. Thanks for listening.